And it's my pleasure to welcome Professor Govindaraj, one of the best accounting profs in the US. Professor Govindaraj is a professor in the Accounting and Information Systems Department and affiliated faculty in the Management Science Department, and is also director of the PhD program at Rutgers Business School. He's been teaching there in PhD and EMBA and MBA programs. He has earlier taught at Stern, New York, Kellogg, Northwestern, and Columbia. Published research papers in leading journals. He has been editor, associate editors, reviewers for several reputed accounting and finance journals. He is an unprecedented two-time recipient of the Paul Nadler Award presented at Rutgers Business School. He has got MPhil and PhD degrees from Columbia, MA from Wharton, Pennsylvania, and MBA and BTech from IIT. Welcome, Professor.
Thank you so much.
All right. So yeah, I always find it amusing to hear my own resume. It makes me feel so old. So I've been around for a long time. I look around and said, yesterday I looked like you. So how many of your MBAs, pure MBAs, first year, second year MBA, what's that program called? PG something? Anybody from that program or? Okay, which year? First, second? First year. And the others are from different programs, I presume, right? So you all have a background in finance, accounting, economics? Okay, at least some background. Okay. So actually I'm not here for any teaching a class or anything. I just happen to be here because there's a conference coming up tomorrow and there are a whole bunch of us visiting. So I came one day earlier, and since Nirav offered me a place to stay, I thought I'll do a little bit of repay his generosity by teaching just an hour of class, an hour and a half. He's given me about an hour and a half. So let's see how far we can go. Okay, and I'm going to be around, so if you have any questions, you can always ask me later. So this is a class that I actually developed at Columbia when I was teaching in Columbia. So it was the kind of class that I wish I had when I was in Wharton. So it's one class that kind of brings together all subjects. Currently, actually, I'm teaching in 3 different departments, so finance, management science, as well as in the accounting. So I have to kind of come up with subjects, but nowadays I teach mostly PhDs and MBAs, but I do teach MBAs, and then I want to develop a class that brings together all the different subjects, because each subject, when you take those classes, they look like separate, completely separate. You do accounting, you get graded, you're finished with that. Then you do finance, and you don't know what the hell the connection is between them. So when you get into the actual world, you'll find that business doesn't come structured like that, an accounting problem or a finance problem or a marketing problem. It just comes as a business problem, and then you're supposed to solve it. So one of the nasty tricks that I do pull when I sit on interview boards is just what I'm going to do today. Give you a bunch of numbers and ask what you think. All right? This is like high-pressure Wall Street stuff. It's kind of fun, so you're taking the right spirit. In fact, the amusing story is my former roommate at Wharton, who I taught finance to, did not go for a PhD and decided to go to those Merrill Lynch in those days, became one of the biggest bond traders in the world. So it's kind of amusing that, if you know too much of finance, you become a professor. So maybe you should not know so much. So the best thing is not to know too much, then you become a successful corporate executive. When you know too much, you start thinking and overthinking too much. And by the time you're finished thinking, the opportunities are gone. That's the way it works. All right, so, but in any case, hopefully we're in for, since I just have 90 minutes, and I sent some handouts, I just picked up these. I figured that I'm in a school that is considered a very smart school, so I made it just a notch more difficult than I normally would. Okay, so it's going to be like a game. You can see the handouts. I gave you a bunch of numbers, did I not? All right, so, and this is going to be like, you can cheat, you can work in groups. All right, so I'll allow you to cheat, work together, but the trick is to pick the right counterparty. So you'll have 3 chances. First time you pick somebody, judge the opposite party. If they screw up, then you know what to do. Find somebody else for the next one. So let's see how far you can go. This part of the, it's like speed dating in a sense. So let's start with this first, unless you have questions. Do you have any questions before I start? Or anything that you would like to kind of very quickly, if you have some short questions I can answer. By the way, this is just a small glimpse of what I teach over a semester. So obviously I cannot do justice to what I teach because more than half of my class that I teach in this area is in mergers and acquisitions, which is a fairly difficult subject. And one last thing here, tomorrow my colleague and old friend Ashwath Damodaran is giving a talk through Skype. So you should come for that. I think it's broadcast all over. Okay, so certainly you should come for that because he'll do the valuation part. We used to teach parallel classes at NYU. So the high point of my teaching career, one was Damodaran. We used to have huge classes. I remember the 180 or 200 students. And the other two classes that I still remember was in Columbia was a guy called Bruce Greenwald. Have you heard of him? A very famous professor. And next to him was a guy who used to teach a packed class along with me was a guy called Benjamin Netanyahu, the current Prime Minister of Israel. So these three classes used to run in tandem in the evenings. And so it was kind of fun to teach, and we used to exchange notes after that. The fun part is to see who got the highest feedback from the students. But if you have any questions you want to ask before I start, anything at all? By the way, tomorrow is valuation. I'm not going to touch on valuation. What I do is to see how good a company is. Okay, this kind of stuff, probably what Warren Buffett would do. To say, tell me, what do you think of this company? Not how much is the value. Because remember, even if you say a company is good, it may not be worth buying. And the reason being, anybody. Just because a company is good, you don't buy it. It's obvious answer. What is the answer? Why don't you buy it? Sorry? It's already? Go ahead. To buy, you have to pay money. So if you're smart, there's somebody equally smart out there, right? So what does it mean? The prices already reflect the value. So there's nothing to be made. You see what I'm saying? So saying something is good doesn't automatically mean you invest. They're two different things. However, if you want to go in for the long run, then it becomes of paramount importance to stick with what's important, like a good company. Do you see what I'm saying? There are different things. If you want to do high-speed trading, then you go in and out, then you do the things that, you have to worry about valuation. Part of my job also is I have a lot of PhD students who work in tandem with Prudential. So we do that part too, and some hedge accounts. But, basically high-speed finance. But that's not what I'm teaching here or even want to give you a feel for. There is a lot of excitement just looking at numbers. One last thing here, and this I'm telling you after having done most of my work, PhD work was in mathematics. So, but having done all that and a lot of finance, I still think the best thing to be a good corporate executive, even a good researcher in finance and accounting, you must have a very good knowledge of accounting. Without that, you're sunk. And this, I'm not saying this lightly at all. You must understand numbers. After that, you can build fancy models, starting from diffusion processes and all kinds of option pricing models. Okay, so if you don't have a good feel for finance, good feel for accounting, you will not do so well. You can get lucky, but you will not really understand finance. So it's kind of interlinked, or for that matter, understand business. Okay, so this is my strongest advice to you. Pick up as much of accounting as much as you can in your stay here. And then you can take classes in finance and other subjects to economics and so on and so forth. All right, but the base comes from here. So instead of wasting time talking more, I could go on like this if I had a whole semester. But let me start off with what I gave you first. You all have the handout. I don't know how you printed it. There's something with 7 columns. You see that? You see the 7 columns. All right. So we'll spend about half hour on this. You guys have the handouts or no? Well, maybe find somebody who has. All right, there's 7 columns. So tell me what you're looking at. By the way, you have to forgive me, I'm slightly jet lagged. So you'll forgive me if I start mixing up numbers here and there. But I've been drinking coffee steadily, so hopefully that will help. All right, so 7 columns. Tell me what you see. How did you come up with that conclusion? Huh? Let's start with that. 7 years? How did you come up with that conclusion? You're looking at the balance sheet, you said. Okay, what else do you want to say? Go ahead, quick. How fast you can absorb numbers. What else? All right. Anybody else on this side, quickly? So as I said, I have just 90 minutes, so we got to go really super fast. What are you guys looking at? What did this guy said, 7 days, 7 years or something?
7 different companies.
And how do you know that?
Because, okay, if we see inventories, inventory ratio is very different. Then we see property ratio that is very different, ranging from.
Okay, so what? So no, I know. So what?
That means that every company has different amount of volume of.
Okay, let's start with the fundamentals. Pure logic. 7 columns, right? One option was across time, 7 years of time, right? For those of you interested in statistics, it's called time series. Another one is what? 7 different firms, perhaps. I don't even know whether it's 7 years or 7 quarters. It's just 7 across time, right? So first of all, you must know what time itself means. What's the meaning of time? Very quickly. Sounds like a lecture in physics. I heard most of you are engineers. What's the meaning of time? How do you know time is passing? Well, one way to look at the mirror and see yourself. You'll soon figure out that you're aging. The meaning of time, the exact definition of meaning of time is the passage of events. If nothing happens, time has not passed. Do you understand? That's the meaning of time itself. Time doesn't exist if there are no events. Something must have happened, right? So I'm sorry to introduce some physics later. A lot of this is driven by mathematical background, so you'll see a lot of physics seeps into my lectures. So there's 7, it's not possible to have 7 different years or 7 different quarters here. The numbers are just too far apart. A number that can go this way is a screwed up company. It cannot exist. Do you understand? And therefore, you can immediately rule it out. So therefore, the other alternative is what? Probably 7 different firms, right? That's the only logical conclusion. So you got to be strictly logical in this. Okay, I'm taking it from first principles. So there's 7 firms. And the second thing you said was the balance sheet. I don't see any balance sheet at all. And why is that? No, that's not the way to look at it. Why is it not the balance sheet I've given you? No absolute numbers. Who said that? Very good. If a real balance sheet, let me take, since you're there, I'm not picking on you, but tell me what is it that I've given you now? I've given you what? I have taken all the numbers in the balance sheet and divided it by what? Okay, I'll come to that question next. Okay. No. In this case, exactly. Precise answers. Okay, what is operating revenue? What is operating revenue? What's the definition of operating revenue? Exact definition. And why do I scale it by operating revenue? There are 2 questions very quickly. Go ahead. First of all, why do I scale things? Why do you scale anything? Very good. Very good. You can compare across an elephant and an ant. Right? A Microsoft is something small, basically. That's the idea, right? Otherwise one will be in billions and one will be in some thousands. You understand? So you cannot really scale it. That's why when you draw a graph, you probably take a log scale to bring it down and make it more comparable, as long as they don't change the characteristics. Second question is, why do I scale by operating? What's operating revenue anyway?
That's your core business outcome.
What do you mean by core business outcome? Very good. So if you're looking at a company like Dell, you have to judge the performance of the firm only by what you think is the main line of business, not what I do on the side. For example, if somebody judges me, they should judge me on my stated profession of being a professor, not being a gangster at night and making money from that. That doesn't count. So, okay, so what you see what I'm saying? My chosen line of business, you judge me on what I state is my most important business goal. And one last thing here, why operating revenue? I could have scaled it by anything. Why operating revenue? Because what? What's the economic reason?
But that is the thing which I am earning after doing everything. It does not take into account.
Oh, I would say exactly the opposite. What's the single most important function of any firm anyway? What do you do when you put out your resumes? You're putting out resumes, are you not? I see a bunch of guys wearing suits and stuff here on the road. I saw quite a few. What are you doing? Basically, you're selling yourself. At the point you accept a job, you're sold. That's the whole idea. A resume is what? Simply a sales pitch. If you don't sell, you don't exist. Do you understand? So, why do we scale anything by operating revenue? I could have scaled by a lot of other things, but I chose this. And let me just give you a little quick, I can't go into all details. When you're comparing firms, this is the best thing to scale by. For example, let me give you only one example. consider this number. You know what COGS is, right? Let's say operating sales is same as sales. There's no other one line of business. Okay, let's say this is 0.93. What does it mean in English? But you'll have to tell me in dollars, okay? I can't think in rupees. It's been ages since I've traded in rupees. Now I can't even find rupees now. So tell me in dollars. For every dollar of sales, you spend 93 cents on whatever you are trying to procure and sell. So basically, the gross margin is the difference between operating revenue and the cost of goods sold is often referred to as gross margin. Is it not? Remember that number. It's an extremely important number. So 0.93. What kind of company is this anyway? 0.93. Manufacturing, absolutely not. The company will go out of business. This company, 0.93, will typically be representative of either a wholesaler or it will be some kind of commodity trading. Commodity trading will be 0.96. How do I know? I just know. You just know. 0.93 will be like something like a wholesaler. Okay? And we'll see how this all plays out. Now you see, what did I say in English? I always said something very important. You see why we scale things. People take this for granted. I don't care what engineering had done before. First of all, they don't teach mathematics properly in engineering. After going through IIT, I still know that. So operating sales. What is operating sales anyway? See, that's the most important thing. So in English, what did I say? For every dollar of sales, right? How much am I spending on whatever I'm trying to sell? Is it not? Every sentence begins with that one note. What thing? So basically, the denominator is the center of the universe. In the language of economics, known as a fixed point. You see what I'm saying? A fixed point. There's only one fixed point in the earth. You know what that fixed point is? The center of the earth. Because it's twisted on any axis, that's the only point that stays constant. Okay? So anyway, this is the fixed point. So this fixed point, basically everything revolves around how it contributes to sales. Do you understand? So if two firms in the same sector, if one had 0.93, another one had 0.7, it's obvious you can rank them somehow and say that which one is better. Clearly. So you get an order. You see what I'm saying? But there's another trick to the whole thing. I just put these numbers down as a starting point. But these are not credible numbers. Which is the eraser for this? I haven't used chalkboard in 20 years. This one, right? Okay. So now we are done with this. If I blocked you from using operating sales, what's the second best choice? What's the second best choice for scaling? Gross margin. And what is gross margin by definition? And that's what you want to scale by. Gross margin is what you want, right? Sales, when I say sales, it always means operating sales, okay? I just don't feel like writing so much. I told you I was jet lagged. So I'm trying to cut down on the writing. It's not a good choice at all. Why? It's a terrible choice, in fact. Why? I'll give you the answers. You tell me why.
Because it includes sales, which we are trying to overcome.
Oh, that's fine. But why? You have to give me an economic reason or a mathematical reason why you should not scale by these. You can divide any number by any number, you get a ratio. That's the meaning of a ratio. You said gross margin, right? So it will be cost of goods sold by you can always do that. But I think it's a terrible choice of financial analysis. Why?
It's very industry specific.
No. When you scale anything, it becomes industry non-specific. That's the reason we scale things in life. Of course, it will be reflected. It's not a mathematical reason, it's an economic reason, mixed with accounting, mixed with finance.
Your operating expenses are not...
Everything is inside. You can choose, there are 100 things you can choose from, cost of goods. So inventory, this, blah, 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 you can go down the damn list. You can scale by anything you want. You see what I'm saying? This is a terrible choice.
The way cost is valued across industries is very different.
So what? Yes, that's why we scale in the first place. That's the whole point. We want to do that despite what they sell. I can compare a Walmart to Microsoft to IBM. That's the whole trick. I want a generalized approach, not just specific to anything. Go ahead, give it a shot.
Even with very different sales and COGS, it might lead to the same gross margin.
In a funny way, you are there. In a funny way. Suppose I say this is 10. I just put a number aside, hypothetically, okay? In how many different ways can I get 10? Many different ways. Okay, let me give you an information theoretic argument. This is a function of two different things. if you give me these two, I can reconstruct this. By the way, this is also the basis for options. But if I give you this, you cannot go back here. Do you see what I'm saying? It's also used in bonds. If you give me the yield to maturity, you cannot get the term structure. But if you give me the term structure, I can get the yields. So basically, knowing the pieces is always better than knowing the thing. Because when you use this, you already lost one dimension of information. Your compressed information into your lost information, because two things can go in opposite directions. You see what I'm saying? So if you scale by something pure, and what's the purest thing you can scale by? One is operating sales. As a second choice, think of what you do. If you want to start a company, what's the first thing you need? What's the first thing you need if you want to start a firm? Go ahead. I have a different idea. First of all, you need an idea before you start anything. After that, you want to make money and sell something, right? Before you can sell something, right, you have to put in the assets, right? There's an old saying, everybody wants to go to heaven, but you first have to die. So therefore, if you want to sell something and be successful, you have to put in the effort by putting in all the assets. Is it not? So what's the closest thing to operating sales? Next is total assets. You should try both. You'll probably get similar results on scaling, but some things will be subtly different. You understand? And there are other things you can do. Who would have thought scaling is such an important thing? It's tremendously important how you do things, because it's the core of what you do. The denominator controls everything. Do you understand? That's the way it's controlled. Like I said, it's the point at which everything revolves around. All right. Now, what else have I given you? Very quickly, because I got to finish quite fast, and I at least want to give you 3 cases. What else have I given you? I've given you the balance sheet scaled. What else? Where is the cash flow? In any report, annual report or quarterly report, what are the 3 basic things they put out? So what is the thing that I have not given you? Which statement? I have given you no statement. Of the statements I have given you 2, both are scaled. One is the income statement scaled, the other one is the balance sheet scaled. Is it not? Okay. But for the purpose that I am interested in, I don't need the absolute values. I just need relative values. That's why I scaled them. Okay? Now, there's so many other little points, but I'm going to be here for a couple of days. If you want to catch me outside sometime, that's fine. I'm going to play a game with you. I'm going to give you the names of 7 companies. Okay? And describe for you briefly what each company is. All right? That's the hard part. You cannot use anything beyond what I tell you. No insider trading. All right? All you have to do, I'll give you 5 minutes. You tell me which column is which firm. Okay? And you can cheat. What does that mean? 4 or 5 of you can get together. So 4 or 5 times 5 is quite a lot of time. Okay? And let's see how well you do on this. This actually shows you if you really understand your corporate finance as well as your accounting. The first one, I'll use this board. Is a company known as, let's call this A. Have you heard of this firm? Wyeth? All the firms I'm going to give you, I'm going to make it easy, relatively easy, which means all I'm drawing from more or less from pharma sector. Okay? First one is Wyeth. Wyeth is based, most of these so-called traditional companies of pharma are based out of New Jersey. By tradition, just like computers are in California, traditional pharmaceutical firms are always based in New Jersey. The biotech companies, because it needs very computer intensive, and also because of the medical school in San Francisco, the doctors started at firms, everything has moved, the action has moved to the West Coast. But the old companies have grown by buying the so-called biotech companies. Like the famous biotech companies are Amgen, Genentech, and so on and so forth. Very successful firms. But Wyeth is old school. It doesn't exist by itself anymore. It was bought over by a company called Pfizer. Okay? Now this company is based out of, when it was alive, it still has its own separate balance sheets and things like that. Based out of Madison, New Jersey, not very far from where I teach. And they do not make over-the-counter drugs. They only make drugs that are prescription. They're also known as ethical drugs. Okay, so any drugs that they make are simply made only by prescription. Okay, they specialize in prescription drugs, and they're a traditional pharmaceutical company, which means what? They're not really into A large proportion of their operation is still inorganic compounds. They don't actually use genetic compounds or DNA manipulations, right? Like Genentech or Amgen. Is that clear? You understand what I'm saying? They make a number of prescription drugs, life-saving drugs. That's one. The second one I'm going to give you is a company also quite famous by now, one of the more successful biotech companies, Amgen. Amgen is headquartered in Thousand Oaks, California. Like I told you, it's a new kind of firm. They make genetically carbon-based, genetically modified, and they do all the genetic kind of, they dissect all the different codes and so on and so forth, and try to find drugs that are extremely powerful but highly focused, like the latest treatment for HIV or cancer or so on. All right? But they, relatively new company, all right? Most of this biotech company started in the 80s because it's a marriage between biology and computer science. You see what I'm saying? So this is exactly what they do. The third company is a firm called Mylan Labs. Mylan Labs is headquartered in Pittsburgh, Pennsylvania. Okay, it's one of the large generic pharmaceutical firms. They're the earliest players in the generic market. Because the healthcare costs in the United States are out of control, they figured that if they can wait for the patents to drop, they can reverse engineer. Like in India, it will be something like Dr. Reddy's Labs, or what's the other company, Cipla. They all wait for. They don't really have drugs that are original because original drugs take a lot of research and time and effort. I mean, 95% fail. But these people wait for patents to drop, and they will reverse engineer. Okay? Reverse engineering doesn't mean the formula is given to them. They still have to do research because the active ingredients are the same. The inactive ingredients are different. Okay? So this company makes, which is the largest generic company in the world? Pharmaceutical. The largest one. Just out of curiosity, let's see if you read the papers. By the way, there is a paper called Wall Street Journal. You might want to look into it. Which is the largest player? No, Pfizer is an typical ethical drug company. They make original drugs. No. Dr. Reddy's, they are good, but they are small. The largest drug company today is Teva from Israel. It's the company that dominates the generic thing. The second one probably is Novartis. It used to be the big one, but now no more. It's now Teva. So it's based out of Israel, and they've been very, very successful. Okay. This is the next one is a firm that should be known to you. It doesn't need introduction. It's very near my school. J&J stands for what? Johnson & Johnson. Everybody knows that. It's actually a holding company. They make their own products. It's not really a pharmaceutical company. It's very important to classify them correctly. The largest healthcare company in the world. They not only make prescription drugs, they also make over-the-counter drugs, the most famous brand being Tylenol, which is nothing but acetaminophen. You know what that is? It's given for headaches and stuff like that. So they have a lot of competition. The acetaminophen is now, well, I think in India it's called, what's called in India, acetaminophen? I know it's available. I don't know what the hell the name is. No, paracetamol. Paracetamol, that's what I think it is. Look at the ingredients. Next time, before you swallow the drug, take a look at the ingredients. You should know what you're putting in. So next time, read the label carefully. The other one, which is also used for not direct competition, the other one is what? Ibuprofen. I think it's called Brufen in this country. Okay. All right. So ibuprofen. And Motrin is a brand. All these are different. They actually are slightly different from each other in the way they act. But they kind of have the same kind of application. But J&J also makes, they were the first people in '89 to introduce things like, laparoscopic surgical equipment. And they own a lot of other firms under the umbrella of Johnson & Johnson holding companies. And they make everything under the earth. The only thing that's common to what they say, they make baby oil, bandage, Band-Aid, earbuds, whatever. The only reason they are called a pharmaceutical company is because somehow every product of theirs is related to some health. Whether the baby's health or whatever. You see what I'm saying? That's the only reason they are called that thing. So J&J is that firm. This you probably haven't heard of, and I forgive you for this if you don't know this. Covance. Covance is a company, a very successful company based out of Princeton, they do not make anything. They're simply a testing company. When drugs come out, before they can come out, they have to test them in the market. And they need a lot of research and statistical research, as well as a lot of MDs and so on and so forth working on these things. They have a highly qualified people. Many of them are doctors, many of them are PhDs, and a lot of statisticians. They do testing for the FDA, okay, before the drugs come out. Are you guys with me? It's a service company, really, but only in the pharmaceutical sector. Then the next one is Cardinal Health. I heard of this company? Never heard of this company. Cardinal Health is one of the biggest players in the US in wholesale market. They buy drugs from almost everybody and then sell them to hospitals and chains. Okay, there are only two big chains left in the US. One is CVS, other one is Walgreens. And I don't know, in this country, I think the nearest I see is in the airports called Guardian. Have you seen the Guardian Pharmaceuticals? Retailing? Which one? I am not very familiar, but this is, well, you've been to the airport somewhere in your life. So when you walk in, there's something called Guardian Pharmacies. Have you seen them? It's a network where you buy also, you can, among other things, you can also buy candies, you can buy milk, you can buy, lipstick, you can buy other things, but they are still a pharmaceutical. Why they call pharmaceutical? Simply because at the end of the table, the end, they'll have a pharmacist, probably the only qualified guy they're sitting there. So that's where you get your prescription drugs, okay? So this is not like that. These people buy and sell to them. They buy from everywhere around the world, okay? And this company, Cardinal Health, is based out of Dublin, Ohio. It's in Ohio, and it's like, Midwest land is cheap. You cannot buy real estate in Manhattan. It's bloody expensive. So they'll probably locate it in places where you just need a large space for warehouses. All right? The last one, I'll leave you with this, and I give you only 5 minutes for solving this. Walgreens, this is a chain. This is a chain. If you go to Singapore, the equivalent of that will be Watson's. Have you seen Watson's? Something like that. It's just where you go and buy pharmacy. I mean, I'm not very familiar with what's running here, equivalent of that, but I'm sure there's some pharmacy, like you buy a big shop with all kinds of things. It may not look as fancy as this, but even the corner shop. I saw a few of them in Bombay, but they don't look like regular pharmacies. The guy seems to know everything though. Whatever you want, the guy knows. So it's something like that, okay? So it's 4:35 by that clock. 5 minutes. Tell me which column is which company. Let's see how fast you can do this. Okay, for the next 3 minutes you have the floor. Who wants to start? Anyway, just tell me what he came up with. But when you tell me what he came up with, tell me the logic. Yes, go ahead.
So we start with zero R&D or low R&D. Both Walgreens and Cardinal Health are purely wholesalers come, stockists. They have almost zero R&D.
Okay.
So that counts for companies 5 and 6.
Covance will also have zero R&D.
Okay. Covance will also have zero R&D. Covance will have very few plant and property equipment because it's mostly testing and it mostly uses people. And
okay, go ahead.
So company 2 must be Covance. Then between company 5 and 6 we have to decide which was Walgreens and Cardinal.
Okay.
So because of low margin in the wholesale, we went with 6 as the Cardinal
And 5 as Walgreens.
Okay. And okay, good enough. Let me pick somebody else now. I want to give a chance to everybody.
Yeah, so for Cardinal, you also said he's a wholesaler, so we went high curves, which we just invented. So,
You picked up on what I told you. So which one did you pick as that? You picked Cardinal 2. Okay. And what else? Give me something else.
Intangibles are very high for 1 and 3. The goodwill, so that will be the biggest brands
How do you know?
because they are intangibles.
What is the goodwill anyway?
The brand value or the goodwill.
What's the meaning of goodwill?
The value of the value of the market. So the difference between the
Okay.
value.
No.
Goodwill is
Exact definition of goodwill is what?
More premium you pay.
premium you pay for more than the book value.
So Amgen could be number one because
Hold on, just a minute. First of all, you should never touch intangible. You don't know what the hell it is. Okay. Secondly, goodwill.
It's a difference between your liability
Cost paid
plus
and
stockholder equity minus book value of your assets.
Let's not get so technical. Technical. Give me simple language. If you cannot explain very simple language, I can't understand complex things. Let me help you. It's the money that you pay for a firm minus the book value of the firm, right? But it should not even be called goodwill. No. In my mind, goodwill should actually be badwill because the rest of the money you paid over the book value, most of the time you cannot explain why you paid so much. So in a sense, it's basically, I don't know why I paid so much. And that a company that has a lot of goodwill, actually in my mind, you should sell immediately. All right, but anyway, that's just a side issue. I don't have time to get into why and how, but this is a quick tip. So the name goodwill is probably coined by somebody who's trying to con people. All right, so go ahead. Give me some more firms. Don't tell me what you did. Show me the money. You don't know that because everything is scaled by operating sales. If your denominator is very large, then even if the numerator is large, the ratio will become very small. Do you see what I'm saying? That's the whole point. You cannot argue with me saying that they have a large number of assets. How the hell do we know? We don't know that. You see what I'm saying? 2 divided by 1 is 2, right? 12 divided by 10 is a small number because the denominator controls everything. So you don't know how much they're actually spending. That's the problem. You cannot assume anything. Long ago, I took away the advantage. You don't have those numbers. Show me the money.
Amgen will be one.
C would be Amgen.
Why?
Because the R&D expenditure percentage is very largest, and you said that Amgen.
How do you know the sales is not small? You see what I'm saying? How do you know that sales is not small? I'm playing the devil's advocate. You could be right. There's a 1 in 7 chance of you being right. Probably better chances than that. They're good odds. Maybe 1 in 4 actually. They're pretty good odds, especially in horse racing. Very good odds. In Las Vegas, there's tremendously good odds, very good odds to play with cards with.
Amgen is actually one because it's a new growing company. Interest expenses are also high among all the other companies. Interest expenses.
Why are they related at all?
Because a growing company would be.
Let me give you a quick intro into that. Since you raised the point, I was not going to teach you any other stuff. Let me take you back to basics. This is a tautological equation, right? This is often referred to as something like some accounting equation or something. In my mind, accounting is fairly uninteresting because everything is completely deterministic, just like chess. There is no uncertainty. Okay, everything is deterministic. There's no fun in these things. It's pretty easy, actually. See, if you write the equation this way, the right side are your assets. The left side is the asset. Right side, how you came up with the money. The right side is a decision variable, and often in corporate finance, it's known as debt versus equity ratios. Right? It's a choice variable. That's another reason why you should not scale things by anything that's choice variable. The assets are there. I told you can scale by assets, remember? But never by the right side, because 2 firms can do the same thing and choose different combinations of debt and equity. Do you understand? And one last tip here. A firm whose assets are performing poorly, in the short run, they can play some games with the right side, debt and equity. But in the long run, they will not exist. So it's completely controlled by the performance of the assets. Okay? So the debt and equity games are only useful as long as they are market imperfections like taxes, which give you an edge on the interest deductions. But even that, at the end of the day, the assets are not performing, the company will not survive. Okay, this is a very neat way to look at it, and if I have time, we'll see in the end what I can tell you about this. In the interest of time, I'll show you how this is done once. Okay? First of all, I would never even look at the numbers. It's completely wrong. I haven't looked at the numbers too. I just printed them out and sent it to Nirav. After that, I have not looked at it because I'm busy doing other things. First of all, I looked at it. Why is the problem interesting? Okay, I mean, it's a very easy problem, relatively speaking. Look, how do you solve such a problem? I'm not interested in the answers, I'm interested in the approach, how you think. That's the only thing I care about. I don't even care a damn about the answers. But if your logic is correct, the problem should fall apart. First of all, it's relatively easy because only 7 columns, right? So when you have to take a little bit from warfare. Essentially, when you're faced with a big enemy, you try to splice them into smaller and try to defeat the enemy. Is it not? This is a set of 7 companies. I start looking at it and say, okay, maybe you can make the problem a little smaller and attack the small thing first. So break it up into subsets, right? You can make different combinations of subsets. How many subsets should you make? Why 3? What about 7? What does it mean to 7 subsets? If you make 7 subsets, what have you done?
You're not uniquely connected. You're not solving the problem.
If you make 7 subsets, you solve the problem. So you cannot make 7 unless you solve the problem. So what's the reasonable way to approach the problem? I'm asking you this because I know should be engineering students are taught like this, or at least should be taught like this.
Take the variable that varies most.
How do computers work anyway? Tell me about how do computers work? Basically, the one Neumann logic. 0 1s, right? There's nothing like half. This is a standard except for fuzzy logic. 0 1. What does it mean? Binary logic. The equivalent of that in coin tossing is tossing a fair coin. I'm sorry, in probability, tossing a fair coin, head or tail. Is it not? I claim most of life's problems can be reduced to 2 choices. All right? So let's see if I can employ this trick. Suppose I look at these firms and draw this tree. I have a list of 7 companies, do I not? It kind of started out well with your thing. I would not take that approach, but something like that. I'm looking at this. If you look at this, suppose I ask the following question. Of these 7 companies, how many of them are manufacturing? It's an economic activity, right? How many of them are manufacturing? This one, and this one. I told you it's an easy problem. I made it easy because I gave it like that in the interest of time. And the rest are not, isn't it? So what is the 0-1 breakup? So you're dividing manufacturing and non. Otherwise, if you put something else, it won't add up to 7. Because something could be non-manufacturing and not manufacturing and not, if you put service, it could be not service either, something else altogether. It has to add up to 7. This is the binomial logic, all right? So manufacturing, I have 4 firms, is it not? Okay. In pharmaceutical, it turns out you cannot have, your one dimension is lost. What is the dimension? Basically, if you want to exist in the pharmaceutical sector, the dimension that you lose is that to survive, you have to do R&D, okay? Now, why do you do R&D? What is R&D anyway? What is R&D?
New product. Future new product.
Or willing to develop new products.
I'm not asking for what R&D, I know what R&D means. But why, I'm just asking you, what the hell does it really mean?
You are trying to go with new patents.
Let me put it differently.
Obtaining patents finally.
Customers.
Obtaining patents finally.
Find solution for problem.
Competitive advantage.
Let me give you another little economic trick. Look, everybody wants to survive in the long run, is it not? So what is the thing that the pharmaceuticals work in? They develop new drugs and they get patents on this. For 17 years, nowadays, depending on the drug, it can exhaust in 5 years. Nowadays, in some countries, 0 for special diseases. Right? That creates an arbitrage opportunity. You can buy drugs in Africa and ship it to US. There are a lot of online drug companies that do that, illegal stuff. But in any case, I'll give you a quick trick here. The reason, and software industry is the same way, they have to do a lot of, in computer industry, they keep innovating. They innovate to survive. And the depth of innovation will depend on how quick the product becomes either obsolete or falls off the patents. You understand? So R&D and manufacturing go hand in hand because without having R&D, they will not be able to survive. So the depth, and I'll come to this point in a sec. So R&D and manufacturing, when you say R&D for pharma, R&D and manufacturing go hand in hand. You cannot separate the two. For other firms, you can, but not for pharma. So now let's look at the numbers very quickly. I had other things, but I will tell you a quick approach. How many firms have R&D? Numbers, give me the numbers. No, give me the numbers. 1. Give me an order. 1, 3, 4, and 7, right? So in some order, there should be Vyeth, Amgen, Well, let me not write here. We have these 4, right? Some order, is it not? Now we get a little greedy. What's the property of a tree? Excellent. Nothing stops me from pushing the branches further. I can, and this is non, is it not? And what are the non-numbers left? No. Give me the numbers left. We have 2, 5, and 6. This is absolutely trivial. If you got this answer, you kind of deserve to be at IMA at a margin. All right? It's nothing big. Okay, I mean, that's not going to land you a job in Goldman Sachs for sure. It's pretty obvious. Let me finish the obvious part. Again, I have very short of time. 2, 5, and 6. Out of this, which are the 2, 5, and 6? This one, and this one. Usually, I would need, it's like chemistry exams. You need a first test and a second confirmatory test. I'm not explaining each and every number. I just need a quick way to get at the answers. Is it not? So let me start with this. Let me crack this one first. It's trivial. Of these, I can break this tree into further. What are these? Non-manufacturing, is it not? What if of the non-manufacturing, this is known as subsets. Okay? So what will be? Service and non-service. Suppose I ask you to break it up here. Which is the only one that is service? This is the only one. That is service, is the only one here. And what's the property of a service company?
No property.
They don't, what do they sell?
Receivables.
So therefore they should not have what? No inventories, right? So which company doesn't, of the 3 left, which one doesn't have inventories at all? So that's pretty much a quick answer. I'll give you another answer later. So the 5 is Covance. It's trivial. As I told you, it's trivial. The other 2 and 6, one is a wholesaler, other one is a retailer. Is it not? Okay. Now a wholesaler, what does the wholesaler do? Buy and sell. He just needs a warehouse. So they will not have too much of property and plant of equipment for every dollar of sales. So which one has the lower property, plant and equipment? Of the 2, 5 is gone, right? So 2 is a good start. So 2 is probably Cardinal Health and 6 is what? Walgreens. But then again, Walgreens is a company that is a retailer. So retailer will have lots more of employees and so on and so forth, and therefore something should be higher too. If in fact, which one did he say is Walgreens? 6 or 2, which one did he pick? I forgot. 6 you picked for Walgreens, right? So what should be high? I just gave you the answer. What, selling and administrative expenses, is it high? Compared to the other one, that's the second answer. And therefore we confirm it, and there's a third answer too, I'll give you that too. So which one is Walgreens then? This 6? So this one becomes 2, and where's this one? 5. So this tree is gone and exhausted. Yeah?
2 has a very low property plant equipment, which seems like Covance because both Cardinal Health and Walgreens should have a lot of inventory and property plant.
You should not go on property. The definition of a service firm is, and I'll give you another way to crack it too. A service firm has relatively zero inventory. That's the key of, that's the definition of a service industry.
So none of them are zero inventory. None of them are zero inventory.
Very close. It's all relative to each other. Which is the lowest? And I'll give you another answer too after that, okay? So this I'm doing quickly, and there are other answers too. Now, so we get rid of this. This is trivial part. This is a little more challenging, is it not? So what? What does it mean little more challenging? Let's get a little greedy here. Suppose I break the tree into the intensity of R&D. I've given you a principle. The intensity of R&D is what? For every dollar of sales, how much do you spend on R&D? Is it not? Okay. Now, of the 4 firms, the intensity of R&D should be directly linked to the, let me finish the economic principle. The intensity of R&D is directly proportional to the operating life cycle of the product. Okay, that's always true. The shorter the operating life cycles, the more you have to put in innovations. Do you understand? That's always true, irrespective of what. Is that clear? All right. Now, of these 4, give me the 2 most intense in R&D. Numbers. I already divided them. Which ones? 3 and 4? So 3 and 4 here, 1 and 7 here, right? But 3 and 4, one of them should be, these are the only 2. Why? Because there's only 2 that make drugs that are purely on the what? Prescription. Okay, the other ones, Mylan Labs is generic, and therefore it doesn't need that kind of intensity of R&D because all it does is reverse engineering. And Johnson & Johnson is tricky. They spend a lot of money on R&D, but they also sell products that don't require R&D. So the denominator is diffused by the number of product lines that don't require R&D, and therefore the ratio becomes smaller. That's the idea. You see what I'm saying? It's a clever way to look at it, like everything else. All right, so which one, of the first one, second, which one do you think is, let's break this up. Wyeth versus Amgen, right? So what do you think, which one do you think is Amgen? Well, if you push that argument, you can probably pick 3 as the 3 Amgen. Okay, right, that's true. Let me also pick another one, a very interesting one actually. Actually, 2 other ones. I see 2 of them. Okay, the kind of drug, you picked which one as I'm sorry, Amgen? I told you I was hit by jet lag. 3 you think is Amgen, right? I need a little more confirmation on this. This one should be 4, right? I need one more test, at least. What does Amgen do? They produce highly sophisticated drugs for which there are no substitute products. If you do basic economics and microeconomic theory, what do they teach you? Substitute and complementary products. Is it not? There is no substitute for Amgen. I told you it's all mixed up with everything. If you don't have substitutes and they make highly sophisticated drugs, which are published only in medical journals, they don't need to do so much of what? Selling and administration. So therefore, you should find relative to 4, 3 should have lower SG&A. Is that true? Okay. I'm just, when I say it, yeah, I know it's true. I just say this. It's a rhetorical question. I always know the answers. All right? So of course it's true. 3. So 3 is Amgen and 4 is Wyeth. One more last thing here. Maybe I should not even say this here now. All right, let's say this is enough for the moment. I told you at least I wanted 2 more cases. So now 3 is Amgen, 4 is Wyeth. We left with 2 more. Which is 3 is gone, 4 is gone, right? This tree is gone. We left with this wing, 1 and 7 as some choice of what? J&J versus? Okay. Now, which one do you think is which? And very quickly.
One has to be J&J because you said how the denominator gets diffused for their R&D because they have a line of products. So that has a lower.
So you think one is J&J. How many people agree with her? Anybody disagreeing? Why is that? You always disagree or just today? Okay, give me a reason.
I think the net margin for J&J is pretty low, 4.1%.
Which one? Net margin means what? Give me, what does that mean? Minus what? Minus what? What are you subtracting out? You're looking at the last line, net income? You're looking at net income. What does that tell you anyway?
So the net margin of J&J is...
No. It's called net income. You're looking at net income, right? Yeah, don't say net margin. That's a completely different term. Every term has... Are you an engineer by profession? No. Did you do engineering? Have you done analysis? Every term has to be defined precisely. You should know what convergence mean in what form. And therefore, you cannot use words that have completely different meaning. Then you lose the audience and you'll screw up on your investments. So use the word net income as a proportion of sale. That is low, you're saying. So what? So what? Tell me. You may be right.
So, no, I know from history that J&J makes more.
There is no insider trading. I told you can only use information I gave you. Tell me something that I told you that should work. Pure logic, not from something you heard somewhere or read somewhere. Very quickly. Anybody? Yeah.
Long-term debt, J&J is 7 because long-term debt of company 1 is around 100%. So an old company will not have so much long-term debt.
Why not?
But if you are expanding,
Which principle of economics are you applying there? Which principle of economics tells you that?
if a new old company is not expanding so rapidly,
Yeah,
then it doesn't require so much long-term funding.
Why? Have you looked at Reliance? Have you looked at Reliance? How much? In fact, if I'm running a company, I'll do exactly the same thing. I'll go and borrow the hell out of people because I have limited liability. If I screw up, I just walk away. So what? That's exactly what I would do. Just the opposite of what you said. All right. How does it work? Well, what does J&J do? Of the 2 companies, which one has a brand name? Very good. What's the meaning of a brand name? This is marketing. What's a brand name mean? Huh? No. I told you to leave that alone. Over what? Very good. If you have, why do people pay so much money for a bag like, Louis Vuitton or a Gucci, or when you can same thing you can do, take a little brown bag and carry money? Why do people pay so much money for a Gucci bag? What the hell does it mean, brand name? No, don't use all this stuff. You're running around in circles, intangibles, the thing. It's a very simple idea. People pay more brand names because it's driven by the utility function of people. People like the feeling that they have made it and other people haven't. So when you see a Michael Kors, you'll find people flaunting Michael Kors because it shows they have arrived. When everybody else looks like a poor cousin. Okay, you get a thrill out of it, and for that you'll be willing to pay a lot of money. Same thing with Apple. Okay, so brand name, all these products, what you call brand name, and when you go to shop in Gucci, those people don't breathe the same oxygen as us professors. I go to Walmart. So they buy all these brand names and pay fancy prices because to show other people that they are rich and everybody else is poor. It's like Trump, a bit like Trump. So this is the thing. For somebody to be rich, somebody must be poor. Otherwise, if everybody is poor or everybody is rich, everybody is equally poor. So it's purely vanity that drives all these things. That's one reason. People pay a premium for various things. Okay? Now, brand name is correct absolutely. Which one has a higher markup over cost of goods sold of the two? 7. That's a good way to start. Mylan bakes, and Mylan, nobody's heard of Mylan. They make no-name products. It's reverse engineering. The cost of goods sold is very high, the margins are very low. Okay, that's the first thing. And let me ask you this. Coming to your point on net income, which market is easy to break into? A Johnson & Johnson type of company that makes both ethical drugs and prescription, non-prescription, high-tech, or a company like Mylan? Which one is easy to competition? Barriers to entry? Mylan. So therefore, you should have a low. I've just taught you two most important principles of economics. Okay? Now, before I tell you the answers, you could have solved this problem in 1 minute. And I was looking for that 1 minute answer. You see what I'm saying? What is that way? I just gave you the answer actually. So I tell you stories, you get lost in my stories. But there's something behind that. How do you solve this problem in 1 minute? What does that mean even? Tell me in simple language. I told you, I don't understand complicated things. So what? You should use the principle I just spent 2 minutes explaining. Have you read utility functions in economics? Something that gives you a lot of happiness, right? That's called utility function. It's not measured in dollars. Okay? Anything that will give a lot of utility, you'll pay more. Okay? Now, vanity is one, greed is another. Actual value is also true value added. Okay? So value addition means what? How much utility it gives some people. Is it not? So, if you have just looked at all these firms, which one brings the most value to the table? All the firms. No, name that. The company's names are there. Amgen. When you're in a deathbed, I doubt you're going to argue about the price of the drug. You'll want to live 1 more minute to write you another will. So you are willing to pay any amount of money. Is it not? Okay. In the order of value add. And where does it show up? It always shows up in the gross margin. What is the gross margin? Sales minus cost of goods sold. Value addition is always linked to the gross margins. If you have just looked at the value addition, you can rank it. What is number 1? Amgen. What is number 2? Baby oil. How much are you paying for baby oil? You can buy some other oil too. So which one is the highest value added? Next one has to be Wyeth. Which is the worst? Which is the lowest value? Wholesalers. This is a perfect order. And if you just put the order down and put the gross margin down, there's 1-for-1 correspondence. And you will have cracked the problem in 1 minute. And you get the same answers. Lastly, to answer your question, I would not look at net income, because net income does not catch any of these things. You can be a highly value-added product, have very low net income, because you're spending a lot of money on selling it. Do you understand? They have in between the gross margin and the last line, there are tons of other items. You understand what I'm saying? And that is driven by competition. Have you done basic competitive economies? Marginal cost is equal to marginal benefits. You're beaten to the last dollar. That's basically the net income. The more competitive an economy, the lower will be your net income as a proportion of sales. So the 4.1% tells you the market, the barriers to entry are extremely low. That's how you solve the problem. You got that? So that is the simple answer I was looking for. A 1 minute answer. So you learn something? There's 4 or 5 different economic principles here I've given you. So you can figure them out later on. Shall we do the second one? The higher the barrier to entry, the less the competition. Okay? And therefore the higher should be the net income as the proportion of sales, according to theory. Let me say one last thing here. If in fact what I'm telling you is these are the way things should look like. If you analyze the company and the company does not look like what it should look like, that's when you have real investigations. If a service company has a lot of inventory, you should start investigating. Just for the record, I just did some guy from Forbes called me here, and I just finished an analysis on Oberoi. He was my student in Columbia, on Oberoi hotels. It's a kind of interesting thing, experiment. So also Satyam, I know somewhere in 2004 I had called that thing that it's not going anywhere. It actually broke down in 2009. The cash flow statement is problematic. But anyway, there's a lot of hidden information here. See what I'm saying? Okay, we have solved this problem. So I can go up to 532, right? All right, now let's do a second one. Again, I'm going to give you 5 minutes. It's too much time. It's supposed to be IMA. 3 minutes. All right? Let's see how far you can go. There's one with, may I please look at the first one? No, first page, please. What did you have on the first page? It should be a long, yes. Do you see a thing like this? I'm sorry, not very much, 0 to 4? 0 to 4. Okay, take a look at that page. All right? Did you find it? Up to 4 columns, I think, 0 to 4. Nothing, no information. All right? Let's see how far you can go. I've given you the cash flow statement, I think, right? And why this time I've given you the exact same value, all the real values. Have I not? And I'm perfectly okay doing that. Why? In statistics, there are 2 ways to run statistical tests. One is, suppose you're running a marathon. There are 2 ways to compare how far how well you're doing. How do you know how well you're doing? Huh? No, that's the mathematical. How do you know you're doing well in the market? There are only 2 ways. The first way is you compare yourself to your competition. That's known in the statistical language as what? What is known in statistics when you compare analysis? It's known as cross-sectional analysis. You compare yourself to your compatriots or competition, but you have to fix the point in time. You cannot compare yourself with sometime when you're 40 years old to somebody who's 2 years old. Everybody has to be in the same idea. You freeze time. You can only change the companies at a certain point in time. That's known as cross-sectional analysis. But here, I have given you the same company over 5 years, right? Okay. This is the second way to say how far you've come. If you're running a mile, now you should have do it half an hour, now you're doing it 15 minutes, you have improved. But if everybody started with you and started half an hour, now doing in 10 minutes, you're screwed. So of the 2, which one should you come ahead on? Cross-sectional or time series? Always cross-sectional. I don't care 2 hoots how far you have come. If everybody's gone further, you're finished. Do you understand? So this is the time series analysis. The inflation rates were very low, so you can compare the dollars across years. Okay? Tell me very quickly, 3 minutes. That's all I have for this one. I'm not even telling you what company it is. This is a tough one. But it's kind of fun. Okay, what were you looking at anyway? Very quickly, I'll give you 2 minutes to give me some feedback. What do you think? How do you analyze this company?
Company seems to be investing in expenses.
Don't tell me about numbers. Tell me a story about it. Do you like this company or not?
This company is in a cyclical industry. It's in a cyclical industry. The income is.
How do you know?
The incomes are dropping in year 1 and year 2 and they're rising again.
Yeah.
So
how do you
there's
know?
like a downside.
How do you know just not buying something, selling something? How do you know it's cyclical?
There is a net positive cash flow from operations which they are using to pay back their interest loans as well as pay.
I know what you're doing, but that's not the story I'm looking for. I give you a bunch of numbers and I ask you what kind of company is this and how.
It seems like a stable one. It has got the stability.
Because why?
Because whatever the investment they are doing, it is just to replenish their depreciation. So they want to maintain the same state of assets.
Is that always true? So is it always true? I'm asking, that's a good point. Is it always true?
Most of the times, they are not in a state where they are expecting much of growth to come.
Really?
So they are not investing much in fixed assets.
So they are acquiring assets and they are moving away from debt and moving towards stock.
That I see that too. That's why I told you should be able to tell me what the company is. At least what industry it belongs to. That's what I was looking for, how far they can go.
Are they going?
They are pushing their product because they are doing prepayments as well as increasing their requirements.
All right, I was looking at the same numbers on the plane. So let me see what I came up with. I apologize once again, I'm really going fast, but that's because I'm running out of time. So I'll give you how to look at this number. First of all, I give you the cash flow statement, is it not? So you must also wonder why the cash flow is always split like this. There are three kinds of cash flows, right, usually. Operations, financing, and investments. And where does it come from? Strangely, it's never explained in books. It actually comes from here. A controls the first two, operations and investments. The second one tells you how much you're investing in assets. The first one tells you how well you're using the assets. Net income tells how profitable the assets are. You know the accrual difference, because cash flow and income are not the same thing. So the cash flow from investment tells you how much you're investing, and cash flow operation tells you how well your assets are performing in generating cash, not profits, cash. That's why we split it like that. And the third one, cash flow financing, pertains to the right side of the equation. It's a decision variable, debt versus equity. Do you understand? I would obviously like to have a lot of debt if I can, because I'm transferring risk to somebody else. But if I don't put in a little bit of my own money, nobody's going to give me money. Do you understand? That's how it works. But left to myself, I'll of course borrow as much as I can. All right? Because the risk is not mine, because of limited liability. Okay, let's look at the numbers very quickly. I'll do this analysis very, very quickly. I won't tell you all the details. The last line, if I look, is what? That is the key point. I told you repeatedly the most important function of a firm is sales. Did I not say that repeatedly? And I've given you an extra bit of information that doesn't belong there, which is change in sales. Have I not? Yeah. And that's the reason. That gets you an extra dimension. Nobody can absorb numbers, so many numbers within 3 minutes, not even me. All right? So I come up with clever ways to solve the problem. I just gave you 3 minutes, multiplied by 4 people. That's 12 minutes for you, isn't it? But you're still not able to absorb it. Let me tell you how it works. How many years do we have? I'm going to use a little geometry here, okay? We'll do geometrical analysis. Sorry, minus 1, 2, 3. It's too far apart. Let me do it close. Right? That's already given. All right? Now, this is known as delta sales. For those of you who are interested in calculus, delta sales is the change in sales, always implicit in the argument. When I'm doing this, it's a matrix. So below that is change in sales. What is change in sales over? Time. But time has been normalized to 1. It's always the case. So you know very well the first derivative is always known as what? Speed. In physics, is it not? The second derivative is known as acceleration. But sales itself is what? It's a flow. Because the change in sales is the one that contributes to income. Income leads to change in retained earnings, is it not? Retained earnings is part of balance sheet. So delta RE is driven by is sales. But delta RE is already a flow, is it not? Per unit time. So delta sales by delta time is second derivative. It's the accelerations. That's what I'm looking at now, the second derivatives. You've never seen financial analysis this way. This is a completely different way of looking at it. It's completely mathematical. Okay? There's a lot of information in this second order derivative, because sales itself is a derivative, speed. Change in sales, it's an acceleration unit. You understand what I'm saying? So we're now looking at accelerations. Let me plot it. I'll do just a rough plot. I don't need the exact thing. Starts off at minus 2%, right? Anything below 5% in a competitive market, you're screwed anyway. So when you say a growth company, what does it mean? What's a growth company mean? No. It's an exact definition. Usually a growth company, in my mind, would be roughly the order of growth of sales of about 15%. Okay? Normal, mature companies would be around 5-7% to survive, under 10%. Anything below 5%, you better watch out. If you're below 0, you're screwed. You understand? So essentially, this already looks like a lousy company. And then, what happens then? It's a really acute problem. Takes a nosedive. And then what? Yeah, but it comes from a lower base, 2% here, and then what? Starting to look like it's some kind of steroids here. And then what? Completely like the whole cycle, okay? Now you got to go a little bit to art. Have you heard of Monet? What is Monet's property? When you come close, all you see is dots. It's the basis for a dot matrix printer too. When you go far away, you see the whole picture. That's known as the Impressionist painting. I claim this is no less than Monet. How? Like a lower half of a sine curve, is it not? Now, we don't know what kind of company it is, but we know that one reason I did like your answer was because it looks like we are seeing some kind of a cycle, right? And this company is going on because it's picking up growth, it cannot die. So I'm just thinking, what kind of company would have this kind of variation in sales all within 5 years? And then I remember Moore's law. What's Moore's law? What does it say in English? The density of the chips, not the processing power. Exact statement. Per square inch or square unit or square this thing, the density of the number of chips that you can put in on a square inch doubles every 18 months, right? So if you take that, one nice guess would have been, maybe you're seeing some kind of a cycle of a firm that comes down and picks up suddenly and the new chip comes out, looks like an excellent growth company, right? Actually, these numbers are picked up from Texas Instruments. They don't make calculators as a side product. Main thing is chips, not potato chips, semiconductors, all right? So this makes a 5-year cycle all within one. I'll prove it's actually Texas Instruments in a few minutes because you cannot make out as Texas Instruments, but you can make out it as semiconductors. Once you have done this, the first line is known as sales. The last line is known as income, the famous bottom line. Once you are finished with sales, the next thing you should look at is you cannot compare levels with changes, is it not? I hate this chalk, it sticks to my eyes. Again, time is required here. Let's plot this. How does it look? I'll do a very quick calculation. It starts off positive, is it not? Completely screwed like this. And then what? Further down? Yes, it does go down and then picks up quite steeply. Very, very steeply, that's important. And then also quite, I'm sorry, I'm drawing it very, very steep like this, something like that. Is it not? Herein lies the answer. This is where the answers come out from. First of all, note something. This is dropping, but this is dropping even faster. When this picks up even faster. The question is, how do you explain that? Huh? High fixed? Fixed costs. Because COGS has two components to it. It's got what? Variable cost per unit of production plus the fixed cost per unit of production times sales. Is it not? That is known as cost of goods sold. Is it not? Now, look at it this way. When sales are dropping, the fixed costs remain fixed. So the fixed cost per unit becomes larger. It screws up your income and it drops very steeply. So now I have known, when you see this kind of a pattern, it's a very good guess that this is a firm that has cyclical and also makes product that requires very high capital investments. What kind of company can be in this kind of a short technology company? It must be a company that makes chips, because all other companies that make parts outsource things too. No fixed costs. That's the exact point. When the sales drop, income drops a lot more. When sales pick up, the fixed costs get distributed across the larger base of sales and therefore it picks up rapidly. And this is proved by the last point here. You look at the delta cash flow operations. Now cash flow operations per unit time, cash flow operations, they derived from where? The indirect method, from net income. Is it not? The first 4 or 5 lines are useless. They add back depreciation and all that stuff. The real action starts with the capital, the working capital, with the accounts receivables. How well you manage your money. Okay? That's where the real action is. But these companies don't have, they're old companies. So their policies are all set. If you look at these numbers here, let me just draw the pattern, just for the hell of it, and you'll see where all things play out in the end. I just plotted it for fun. When it actually looks like this, I'll just draw it. It looks like this. Then it starts to pick up, and then it jumps up like this, and then jumps up like this. You can check it later, the change, okay? If you compare this with this, even though the cash flow is derived from net income, it looks much closer to sales. Is it not? And the answer is obvious, because the first item that you add back is depreciation. And therefore when you add back the one thing that kills the income but not the cash flow has to come closer to sales and not to income. And therefore this tells you that this company is a company which certainly is probably in high technology, probably with limited cycles, with high capital investments, and most like, it cannot be a drug company, because drug companies have a life cycle of, I told you, patents are 17 years, 20 years, so it can't be that long. It's only 5 years. You see what I'm saying? So the best guess you could have made is the semiconductor company, and it is TI. You do the same analysis for companies like AMD, you'll find similar patents. Intel, same patents. What will happen after that? It'll go up like this and then come down. Let me leave you with last thoughts on this. You see, when the company is coming down here, the CEO is supposed to take some action. Otherwise, what's the point of having a CEO? Do you understand? What does it mean? You know the life cycle of the old chip is gone. What will you do? You will invest in the new chips. And therefore, there should be around this time, you should see a spike in the capital investments, fixed assets acquired. Do you see something like that around that time? Huge investments, much more than depreciation. You understand? That's the capital investments. And they dwarf the depreciation because there's new line of products. Normal companies, approximately, it's about 1.3 times depreciation. But for these kinds of companies, it'll be a massive investment. But look, when you put in fixed assets of this order, it usually takes some time to pay off. When does it start paying off? Not when you put here, it actually starts to pay off in around year 3 or 4, 2 years later. Okay? So once again, you confirm that it's probably this kind of company that makes semiconductor chips. One last thing. This is a damn good company. Around this time, the uncertainty is the highest. When you put in that kind of capital investment, you don't know whether your chips are going to succeed or not. Is it not? High uncertainty, the language of finance. So when you have high uncertainty, that means your assets are becoming extremely risky. You feel what I'm saying? And then you can easily prove it. If your assets are risky, a prudent manager should not compound the risk by adding risk on the right side, which is on the financing side. What does that mean? Adding risk. Adding risk, if you want the company to live on, if you borrow more money, it hangs around your neck because you have to pay interest no matter what. You understand? Otherwise, the assets go to the bondholders. So therefore, if you're a prudent manager, what should you do? You should cut down on your debt. Are they doing that? Probably issue some stocks, but you'll also buy back some stocks because at that time the uncertainty is so high, there are a bunch of green mailers waiting for the company to fail. To protect themselves against hostile takeovers, they'll usually buy back their own stocks too. Are they doing that too? You'll find that too going on. They'll buy back some stocks, but like all good companies, there's a myth in the market that if you cut dividends, you're screwed. It's not true actually, but people do believe that. And therefore, this being a steady company whose shareholders are people who demand dividends because their life depends on them, this company will give you steady dividends no matter what. Do they do that? Look at the order of dividends. Steady dividends. You just know. And therefore, there is no story around this company. The company is doing exactly what you would expect this company to do. And therefore, if you want to be a pensioner and invest in a company that pays steady dividends, has a good track record, this is an excellent buy. That's how you do the analysis. I really don't have time. I've run out of time. I had one more case, but I don't know whether you guys want to stay. I can stay for another 10 minutes, but if you don't want to, that's fine too. What do you guys want to do? You'll stay? Nirav, they want to stay for 10 minutes more. I think they're crazy. I mean, that's my personal opinion. Just 10 minutes more. If you want to go, you can leave. I'll just do go. I'll just do one more small case just to show you a trick, and then I'll call it quits. I'm kind of depreciating fast. So I'll tell you what the story is. Take a look at only one more case, and I'll show you how that works. This is the last of the series. What other handout did I give you? Can I? No, Hertz, forget Hertz. That's too complicated and I won't be able to finish. Let's take a simple one, shall we? There's something called Microsoft and Oracle. Have you heard of these companies? Well, if you haven't, this is a good time to confess. So anyway, so Microsoft is what? It makes so-called, I know, but it makes, both of them make some kind of software. Microsoft makes software for consumers, right? Everybody, basically they're known for their Windows and now they're moving to other things like cloud. But before they're known for their, okay. Oracle makes what? Basically database equipment, right? Before they bought a company called Sun, that's another issue. How much did they pay for Sun? precise numbers. Did I mention the Wall Street Journal, by the way? Okay. 7.1 billion. All right, so they overpaid for it, in my opinion. But that's another issue. They make database stuff. Okay. Now take just 2 minutes and tell me what do you think of these two companies. For the first time, I'm making you do something that I have not done before. The data points have gone down. Okay. Advise me, please, as my financial advisor. Tell me what do you think of these two companies. Very, very quickly, because I just have 10 minutes. Not outside the data, within the data, which is a better company.
Which ones? Pick. Look, if you pick randomly, you have 50-50 chance of being right.
Microsoft.
Based on the numbers, okay? You have to justify it. Based on these 3 numbers I've given you. Only those numbers.
So Microsoft, because if it's in the consumer business, you can expect some, volatility. But Oracle, if it's in the B2B business, you should expect some stable.
Why? What theory of economics are you applying? There is no theory like that. There is no theory in economics that ever tells you that. There is nothing like that.
The B2B sales should be relatively stable.
Who said that? I mean, which principle of economics are you applying? That's what or somebody told you that in class. It's something that you think is true. There is nothing like that at all. Yeah.
I believe that Oracle is in a better position because it has the average account receivable has gone down, sales have increased. So the Microsoft case, even they have liberalized their trade policies, and average accounts receivable have gone up, but the sales have gone down.
So you think Oracle has done better? Given the data, I think Oracle is a better company, right? Any other suggestions quickly? Any other suggestions? One person says Microsoft, other person says Oracle, break the tie. Oracle? You all agree? Let's see. Let's see how to analyze these companies. I have made it fewer and fewer data points. The problem becomes more and more challenging, okay, to analyze. This is very close to PhD research, except in PhD research we have a large amount of data. But this is how you do, this is like a high level MBA, beginning level PhD kind of research. Let's see how this works. I just taught you something in like physics, acceleration and things like that, right? Now you learn the tricks. Let me show you how this works. Let me do Microsoft here. I won't even do the calculations. Oracle here, just for the hell of it. Have I given you the sales? Okay, how many years do we have?
3 years.
Actually we have 4. Why? Because of change. Change is always from previous year. Okay, so it's coming, Microsoft looks like, let's use the data I've given to you already. Just use what I've given you. 16%. 18%. Actually, let me be precise here. There's a reason why. 15.5, right? And then what? 18.2. Okay. Now, first thing, Microsoft has rarely been, if you look at the history of Microsoft, never has this company ever had a downturn. So I'm just compressing a long story into a short one. If at all you had to pick one year when they had a downturn, it would be which year? Probably 2000, and the data does come from 2008. You can go and check. Now, this is a trick that you pull. Both Oracle and Microsoft are in the software industry, is it not? Now, this is a quick lesson in macroeconomics. Now, it's not an unreasonable hypothesis to suggest that if something is affecting the one of the companies in the same sector, it should affect the other one in a similar way on a macroeconomic level. And what is GDP anyway? GDP is the sum of all the output of all the firms operating on the soil in India, perhaps, right? It's all the sales output. Is it not providing you sell everything? So every country is measured by its sales. But here is just one company. So a GDP is like, roughly speaking, an aggregate of all this. Is it not? It's a very simple idea. Now, my hypothesis is the same kind of patterns in sales should be reflected in the Oracle. Just a hypothesis. I don't know whether I'm right or wrong, but I'm always right. That's the funny thing. You see? And how does it work? Let's see how this works. This is change in sales, right? Again, it's divided by time. I'm already doing accelerations. Okay? My hypothesis is what the pattern should look similar, is it not? This looks a little steeper, but still on the same track, is it not? And almost it's continuing on the little bit less tangent, and then The slope evens out, right? A little bit flat. So far, my guess here to here, the patterns are looking like far away from each other. I mean, go very far away, they look very similar. So the hypothesis that I held out seems to hold out in the first 2 years. But this troublesome that it doesn't here, is it not? Yeah. How much is the numbers here? 25.2%, and this is 24.6 and 3.7%. The one thing that's a constant is what? No, I'm never wrong. What does that mean? Look at it this way. These two are behaving exactly somewhat similar to this here, right? What order of derivative is this? I just told you. Second derivative. Now you don't have to go crazy. Have you done Taylor series expansions? Right? Approximating a function usually stopped at the first and second moments. First one in statistics is known as mean, second one is known as the variance. Third one is known as what? Skewness. And then you have kurtosis, usually 4. The normal random variable has only 2, mean and variance. You can capture completely everything. But here, for the first time, I'm going to take you to the third derivative. Look at this way. This is increasing, My story still holds, right? But this is increasing at a decreasing rate, both of them. So the macroeconomic effect is captured not in the second derivative. If it's not in the second derivative, it usually comes up in the third derivative. So the sales are increasing at a decreasing level for both. Is it not? The change in delta squared sales by delta T squared. That's what I'm calculating. You see what I'm saying? That's where the macroeconomic effects are. It's hidden in those numbers. Once you're done this, the next thing to plot is what? When you sell something, you probably give credit, don't you? So let me take a look at the other set of numbers. We'll finish off with this. Because I can only compare sales with change in sales and change this. And we'll do delta AR here, and we are done. So let's take a look at these numbers. Actually, I should have, okay, you know where I'm going, right? So this I'll put it here. This I'm going to plot somewhere here. Delta AR, how does it look? It's about 20%. No, not from here. From here to here is 20%, right? About 20%. And then what? And then drops by 0.59%. Something like that. Is it not? Now, this reflects something really important. Do you see something cute about those numbers? Something really interesting. Huh? Of course, they'll mirror sale. The more you sell, the more credit proportion to that, right? It has to be that way. But that's not the point. What is really cute about these numbers is you should observe the magnitude of these two. When you give more sale, $1 of credit, you're probably expecting 1.5 or twice that as sales. That's why you give credit to people, because they buy more. The problem is you're getting less bang for the buck. You're giving 20 cents on the dollar and you're only getting back 18 cents on the dollar. And this can only happen, when will you give more credit? Only when people are hurting. Is it not? And what does that mean? Probably just said 2008, people are probably hurting, give more credit. But it turns out you're not getting enough dollar for dollar. You're getting less than what you're giving. Is it not? So what does it tell you? The economy is turning south in some sense. It actually, if you looked at the micro data, you could have guessed that 2008 was going to be a terrible year. You know from the accounts receivable and sales, if the account, for every dollar of credit that you give, if the change in sales is less than that, you know the economy is turning not so good. And this should be true of this firm too, because they're the same sector. Let's check that. Let's just check that. I'll explain the last one later. And that's the cutest part of the story. Let's look at these numbers. How much is it again? I did it's roughly about 26%, 26.4%, and then minus 23.6%. Let's look at these two numbers. The sales, you're giving again the same story, is it not? Less bang for the buck. You're not getting enough. Once again, it corroborates the story that things are not looking up good in the economy, is it not? That again, how you check for the macroeconomic effects. Last point. Normally when people are hurting, what would you do? You'll give them more credit, is it not? And it looks like their sales are still increasing, even though they are collecting faster. Now, all those fancy B2B and all that, these are names. I don't give a damn what they are. You're selling to, Microsoft sells to ordinary people, whereas Oracle sells to big businesses. There's a saying, you should be nice to people on your way up because you'll meet them on the way down. Have you heard the saying? Good, it's a good corporate lesson. So what does it mean? When you're selling to big people and you squeeze them during times which are bad, they're going to remember it in the long run. Is it not? And yet, this company persists in squeezing them. Is it not? Whereas this one does squeeze them, but not so much. The sales are dropping, I understand, but not by much. You see what I'm saying? So what kind of company, and I know the people who run, many of my former students, what kind of company would squeeze people in trouble? Either they're complete idiots, which is not true. The only other explanation is what? Why would you squeeze people? Huh? You have to prove this. You should look at the reason for squeezing people is because you're short of the thing that you don't have, which is cash. You should check their cash flow statements, and you'll immediately find out that Microsoft is sitting on a $50 billion cash reserves, whereas Oracle had nothing. And that's why they're squeezing their suppliers. But the question still remains, how are they able to generate positive sales despite squeezing people? The answer is very simple. When you have big projects, you probably sign contracts way early in advance. That's the momentum that comes from previous contracts, not ones that are signing new. If you looked at the numbers going after this, what will happen to this? Probably tank. That's how we know, and that's when I sold my stock in Oracle. That's when it happened, and I told some people to quit Oracle too. So that's how it worked. So on that exciting note, I'm glad I didn't listen to you guys and buy Oracle stock. I just went the opposite. Microsoft is the one that I bought, and I stuck with it. I sold it later for other reasons. But in any case, guys, I hope you enjoyed this quick introduction to financial analysis. Comes alive, the numbers. So I'll leave you with these thoughts. It's been a pleasure, and I hope I have earned my 1 day of good treatment from you here. Very good. Thank you, guys. Take care. Thank you very much.